Hi everyone, this is Andy from Rookie Investor, and in today's video we'll try to answer a question asked by many stock traders, which is, can I make money in the stock market? Well, of course you can make money in the stock market if you are in for the long term. For decades, investing in stocks was the most rewarding move you could make. Stocks outperformed many asset categories like bonds and cash. However, in the past decades, they have been outperformed by Bitcoin and other cryptocurrencies. Anyway, crypto is an entirely different topic that I wouldn't like to expand on this video, as this video is focused entirely on the stock market. Stocks trace their roots back in 1600. Yes, they are more than 400 years old. And fun fact, the first publicly traced company was the Dutch East India Company. For the record, the company ceased operation in 1799, so people that invested and held to the end, they lost their money. I bet some of you will be like, bro, you just told us you can make money in the stock in the long term, and the first example you give us is a company that went bankrupt. Well, it happens. There is no way I can change the facts. In general, though, over the past 100 years, if someone has invested in stocks and held for a long period of time, there's a huge probability that they did really well for themselves. And when I mean long term, I'm referring to 10 plus years. The reason I insist so much in the long term is because many fellow traders that I happen to know are obsessed with the quick crypto profits, and recently the pump and dump meme tokens and stocks. These traders, if we can call them that, believe that long term is a couple of months, some of them weeks. This is the second time I mentioned crypto in a stock market video, but I had to make the comparison and explain what long term means in today's terms. So, looking at the Dow Jones Industrial Average Index and the S&P 500 for the past 30 years, we can see that stocks tend to go higher and higher over time. That doesn't mean that stocks don't lose their value. It goes without question they do, but in general, over time, they tend to rise. On your screen, you should be able to see the S&P 500 historical return since 1995. For the past 26 years, S&P had closed higher than it started the year 21 times. Let me say it one more time. 21 out of 26 years, the S&P rose in value. For those who love percentages, that is close to 81%. And even more, in the last 20 years since 2001, we have seen only 3 years in the red. 17 out of 20 years in the green, which is an 85% rate. And of course, during all these years have been some negative years, and this is absolutely normal. Now, for you that may not recall every crash or correction that happened in the market, there's always a very good explanation behind it. For example, the dot-com bubble in 2000 caused the market to close in the red for 3 consecutive years, something we never saw or experienced again in the past 30 years. Even when the market crashed in 2008, the weight of the housing bubble only caused the market to close in the red for 1 year. That was a pretty steep year for many people, as the market crashed by 36.55% on average and many companies went bankrupt. I do recall this one a lot more than the dot-com bubble given the age, and I bet most of you do as well. The last time we saw the market correcting was back in 2018, which is a slid back for about 4%, which was nothing major. Now allow me to make a prediction that 2022 will be in the red. And if I'm reading the market well, it is not going to be the only year. We are most likely heading to a major recession that is caused by our beloved politicians and Federal Reserve, but again, this topic is for another video. Also, usually after a market correction, we tend to have quite strong rebounds. After 2008, the economy bounced hard, and we have seen years with 25% and 32% rise. Also towards that direction helped the emerging tech sector with Apple, Amazon, Alphabet, and Tesla to rise greatly the past decade. Last, in 2020, when we had the pandemic and the economy was about to go to shit, the Federal Reserve and the politicians gladly printed trillions of dollars and they rescued the economy, which at the same time blasted the stock market much higher when it shouldn't. Unfortunately, we will have to deal with this mess for the years to come, and I'm referring to the massive inflation we're facing today. I think I'm getting a bit sidetracked here, so let's get back to the data. Looking at the S&P 500 for the past 30 years, the average stock market return is 9.89%. Do note here that this rate takes into account that dividends received have been reinvested. For those not familiar with the word, a dividend is a distribution of profits by a corporation to its shareholders. When a corporation earns a profit or surplus, it is able to pay a proportion of the profit as a dividend back to the shareholders. Let's take Apple for example. They have been paying dividends every quarter. And as you can see, they are on the rise since back in 2015. They were about 13 cents per quarter, and now they're at 23 cents per quarter. That could change depending on how profitable the company is. But if you hold several stocks over the years, 80 cents per stock can add up. That is definitely an additional perk of owning stocks. Keep in mind that not all stocks offer dividends. I will dedicate actually an entire video on dividends, how they work and what stocks pay the best. Anyhow, the return of investment was 9.89% for the past 30 years. However, that doesn't mean that the next 30 years will perform the same rate. But we need to base our calculation on data that has some merit, and that data will serve that purpose. For this calculation, I will use an investment calculator. You can find plenty of them online by searching the term. Basically, this calculator will show us how much money we could have made if we invested in the stock market, or potentially how much we can make if the market behaves in a similar pattern in the years to come. We will assume a starting point of $5,000 and a contribution of $5,000 per year. That is about $450 a month, give or take, which is doable for most people, or at least I want to believe it is. Feel free to adjust your numbers to your situation. For the first calculation, I will use a 10-year investment. If you start with $5,000 and you add $5,000 every year, at the end of the 10 years, you shall have $92,108. Your profit or total investment for the 10 years will be $37,108, because if you add $5,000 a year, that will be $55,000 by the end of the 10 years, including your beginning capital. I am pretty sure that some people will be thinking the following: bro, I am able to make that in a week trading crypto. Well, the average person cannot, and I can assure you that for every trader that makes money, I can find you at least 10 people that they lost money. Not just in crypto, in stocks as well. Back to the calculator. As this is a compounding interest of an investment, if you change the 10 to 20 years, you will see a big jump in the money. What a 10 years of 9.89% interest can do? Well, they can increase your profit from $37,000 to $210,000. That is about 550% increase. Not bad, right? And if you play the retirement game, and that is the 30 years, you can see your profit jump to $735,000. So far, I have gone over the past performance, the dividends, and how much you can make. And while this looks great, there is always the other side of the coin. And we need to talk a bit about the worst case scenario that could occur. Well, there's a 2000 dot-com bubble, the 2008 housing crisis, 2020 pandemic, and the 2022 inflation, stagflation, recession, call it the way you see it. By the way, for some people that happen to be my friends, it's nothing going on at the moment, and they think that the economy is good and we're strong. Well, at least they're happy. As they say, ignorance is bliss. In cases like that, the market is correcting, and sometimes it corrects really hard. For example, this year, 2022, if you had invested in some of the major stocks in the market, you probably would be sitting in a loss. For example, at the beginning of the year, Amazon was around $170, and now it is trading around $130. That's a decline of 25%, which is quite high for a stock of this caliber. Microsoft at the same period went from around $340 to $260, which is about 23-24% decline. Then you have other major stocks that performed phenomenal over the past decades, performing in a similar trend. Netflix from $600 is now trading at $230, about 62% decline. Tesla, which from $400 now trades at $290, about 25-26% decline. This is already a bad year for stocks, but it happened before, and they bounced back and rose more than ever before. Does that mean that this will happen again? Well, most likely it will. That is what history shows us, and there's no reason to believe it will not. In Microsoft's case, for example, you can see that back in 2000, they reached $58 per stock, and then during the 3 consecutive bearish years for the market, they were trading even at $20. And in the 2008, they crossed all the way down to $15. But as you can see, not only they recovered, but 13 years later, they were trading at $350, an increase of about 23 times or 2,300%. Market crashes or corrections are a great opportunity to get your favorite stock at a discount, as over the years history shows us that they rise. Many are obsessed with finding the right time to invest, and it's true, everyone wants to buy the bottom. Realistically, that is not quite possible. What is possible is to find good stocks, financially solid companies that serve a purpose, have solid financial reports, and invest in them. Over time, history has shown that they will rise. If you have the money to invest for a long period of time, the patience and the cojones to keep your positions while the market is correcting, and there will be times like that, chances are that you will emerge victorious given that you have picked the right stocks. I will make more videos about stock investing, and one of them will be how to pick the right stocks. So make sure you hit the subscribe button, and of course, if you like the video, please smash that like button. It will really mean a lot. Thank you for watching. See you in the next video.